Mortgage as hours worked. This lesson goes against the get out of debt mindset. So prepare yourself and remember, you're not taught to think this way so they can make more money from your mistakes. Before I start on the mortgage stuff, let me first say something about mortgage insurance. Disclaimer. I am not an insurance agent or broker, so I highly suggest you contact one before taking any action on this subject. End of disclaimer. Generally, if you have more than 20% equity in your home, then you're not required to have mortgage insurance. Mortgage insurance can pay in two different cases. One, you die. Two, you're disabled for a while. A much cheaper life insurance policy can cover you for case one, and a large savings account can cover you for case two. I don't know your specific finances, so I wouldn't dream of making any recommendations, other than I do recommend that you have some type of insurance to help cover your mortgage, just in case something happens to you. Disclaimer, I'm not an insurance agent or broker, so I highly suggest you contact one before taking any action on this subject. End of disclaimer. Another thing I'll throw in here is that I don't think you should get any equity loan for anything other than using the money for a down payment on an investment that will outpace inflation. It's just too easy to blow that money away on unneeded purchases. Why have a 15-year loan attached to your house so you can pay cash for a new car? Buying a house with a mortgage sort of gives you rent control. Only sort of, because like rent, your property taxes and insurance will still increase every year. And homeowner insurance is way more expensive than renter's insurance. And you pay for all the maintenance and repairs. But you do build equity value in your house. This equity is sort of like a forced savings plan. Now back to the actual mortgage. The more I learn about finance and inflation, the more I realize where I've made so many mistakes. Mortgages, especially fixed rate mortgages, actually help you to get ahead financially. So don't pay them off early. Refinancing for a low interest rate is okay. Just drag it out for another 30 years. Why drag it out for 30 years? Because this is a case where inflation works for you, not against you. Inflation helps your property value to increase, and your equity is the property value minus your mortgage and equity loan balances. So your equity increases as your property value increases, and your equity also increases as your loan balance decreases. But if you give it the time that it needs, inflation actually helps you to pay off the mortgage. You can download the Mortgage as Hours Worked spreadsheet from this page. There is a link to the file on the second line of the description of this video. You can pause this video while downloading and opening the file. All downloadable files are free. They are Excel spreadsheets with the XLSX file extension. This type of file was chosen as it will not support macros, which means they can't collect any of your personal data. After downloading, move it out of your downloads folder onto your desktop. Later, you can move it to any folder as you like. Just don't keep it in your downloads folder. The first time you open the spreadsheet, you may have to click on Enable Editing so you can enter your data. The Mortgage as Hours Worked spreadsheet defaults to an example of a $200,000 mortgage at 5% interest. On the page for a 30-year mortgage, the first table shows that you'll pay over $390,000 to repay the loan. You'll pay almost twice for the loan. That sounds bad, and this table is what most people look at when deciding to pay early. The second table titled No Inflation, Amortization in Hours Worked. First, notice that with a salary of $25 per hour, you would be borrowing the equivalent of 8,000 hours of labor. Top of the second table, hours balance column. The bottom of this table shows that you would work a grand total of 15,612 hours to repay the loan. Again, that's almost twice the amount borrowed. But that's if there were no inflation and your pay remained at $25 per hour over the 30-year loan. However, we do have inflation. And the third table titled Real Amortization in Hours Worked accounts for regular pay increases at the average rate indicated by Social Security. And it shows that you'll work fewer hours every year to make your mortgage payments. And because of 30 years of pay raises, your salary changes from $25 an hour to over $88 an hour. And the bottom of the total hours worked column shows that you would pay back a grand total of only 8,906 hours. Because of inflation, you're only going to pay 906 hours of labor for all of the interest on the loan. Because of inflation, you're going to save 6,706 hours of work labor to pay back your mortgage. At 40 hours a week, that's 167 work weeks saved because of inflation. At 52 work weeks per year, that's 3.2 years of labor saved because of inflation. Wow! Since you borrowed 8,000 hours of labor and will pay back 8,906 hours, that's only 906 work hours for all of the interest over 30 years. That's only 11.3% of labor interest spread out over 30 years. It's like a 0.7% loan, while inflation is averaging over 4% per year. It's financially better to take any extra money that you could apply to your mortgage and put it in a real investment that will outpace inflation. When properly set up and used, tabs will help you to save those 3 years of labor so you can invest. What really surprised me was the fourth table. How can I get it there? Let's see. Fourth table. Fourth table, titled Lump Sum Payoff. The column Total Work Hours Paid shows the total number of hours worked to pay off your mortgage early, using money saved since the beginning of the mortgage. The dollars that you saved were earned at lower hourly pay, making it more expensive in work hours because you have to save 2 work hours in the beginning of the loan for every work hour halfway through the loan, and 3 work hours in the beginning for every work hour close to the end of 30 years. The most important thing to keep in mind is that if something happens to your income, the mortgage bank won't care that you've paid ahead on your balance. Even if you've paid 10 years in advance, they still want their next payment every month. By paying ahead, you've limited your debt liability, but you haven't changed your monthly liability. You should limit your monthly liability by having a large savings account and by having the smallest possible payment. Get the 30-year loan. Then save any money that you could send to them because you just never know. If you lose your job, it may take 6 months to a year to replace your income. You'll need to have a lot of savings to keep your home during that time. So when getting a mortgage, always get the 30-year fixed rate. Always drag it out for the full 30 years. And put any extra money in a real investment that will outpace inflation. If interest rates decrease enough, go ahead and refinance for the lower interest rate. Refinancing is generally only worth it when you can save 2% or more on interest. And again, go for the full 30 years. You want to limit your monthly liability. Get the smallest required payment so you can continue making them. Limit your monthly commitment as much as possible and save the rest for investing. Remember, you're not taught to think this way, so they can make more money from your mistakes. You should probably watch this video at least one more time. Thanks for watching.